Gold isn't UTAI moving because the world suddenly got scared. It's moving because the math of real purchasing power is breaking in plain sight, and a lot of very loud people are incentivized to pretend it's just vibes. Right now, the mainstream tape-watching crowd is staring at the same headlines they always stare at, while the actual pricing engine for gold and silver is sitting right in the open. Real yields on one dial, inflation expectations on the other, and the spread between them is where the pressure lives. And before we're done, you're going to have a clean, repeatable checklist for what matters over the next 1 to 2 weeks. The key levels that decide whether this is a controlled retest or continuation squeeze, and the one hidden detail that explains why metals can keep climbing even when traditional models say they shouldn't. Start with the simplest truth. Metals don't trade rates. They trade the credibility of future purchasing power. If you only watch nominal yields, you are watching a headline number that mixes two different things, growth and inflation, and that mix changes by the hour. Real yields strip that down. Break-evens tell you what the bond market is willing to pay to insure itself against inflation. Put them together and you get the cleanest macro dashboard you can have for precious metals. That's why the macro is simple here, even if the price action feels insane. The market is telling you, in real time, whether tight policy is actually tight in inflation-adjusted terms, and whether inflation risk is being repriced higher underneath the surface. Now look at the tape. Spot gold has been hovering in the mid-4600s per ounce, printing fresh records around that zone, with recent January marks showing it pushing from roughly $4,125 at the start of the month into the 4600s, and briefly around 4,675 on late January prints. Silver has been even louder, ripping into the low 90s per ounce after starting January in the low 70s and touching the 90-30 area at points. That's not a sleepy hedge. That's a volatility instrument with a heartbeat, and you do not get that kind of move without forced behavior somewhere in the system. Here's where people get confused. They'll say, but real yields are still high. Gold shouldn't be doing this. And historically, that's a fair instinct, because higher real yields raise the opportunity cost of holding a non-yielding asset. But that sentence hides a trap. Gold's relationship to real yields isn't a law of physics. It's a dominant influence until something bigger shows up and outbids it. And that's the hidden detail most people miss. There are regimes where the marginal buyer of gold is not a yield-sensitive speculator. It's an institution hedging currency credibility, a reserve manager diversifying away from political risk, or a physical market participant responding to supply chain reality. In those regimes, gold can rally alongside stubbornly positive real yields because the market is repricing something even more foundational than carry. It is repricing trust. That's not conspiracy talk. It's incentives and market structure. When trust becomes the variable, price discovery moves to the assets that can't be printed. Now let's make the dashboard concrete. Real yields are the gravity. They're the inflation-adjusted return you can lock in through inflation-protected bonds, and they matter because gold and silver are competing for capital. If the market offers you a juicy real return with low perceived risk, metals usually have a harder time. Break-evens are the fuel. They're the market-implied inflation rate embedded in the difference between nominal treasury yields and inflation-indexed yields. When break-evens rise, it means the market is pricing higher inflation risk. And the key is the interaction. Metals love the environment where break-evens rise faster than real yields, or where real yields start to roll over while inflation expectations stay sticky. That's the purchasing power story becoming expensive again. Over mid-January, the 10-year break-even inflation rate has been sitting around the low 2% area with a print around 2, 33% on a recent update, while the 10-year inflation indexed yield has been around the high 1% area, roughly 1, 88% on a mid-January print. Those numbers aren't magic by themselves. The story is what they imply. The market is saying, even after inflation, you might get under 2% real for a decade. And at the same time, it's refusing to price inflation risk as dead. If you're a macro watcher, you know exactly why that matters. It means the bond market is arguing with itself. Growth is uncertain, inflation is not fully contained, and policy credibility is under stress from multiple directions. In that environment, metals don't need a cute narrative. They need a driver. The driver is the compression and instability of real purchasing power. And when that instability rises, gold and silver become less about fear and more about insurance. Here's the conflict that makes this trade combustible. The very people who benefit from everyone believing inflation is contained, the system is stable, and the policy path is predictable are not the same people who benefit from a loud vertical metals tape. Loud metals are an indictment. They scream that the market is demanding a higher premium for credibility. So you get a predictable pattern. The move gets dismissed as retail mania, as geopolitics, as a temporary headline. But when you anchor it in real yields and break-evens, you see the skeleton. And once you see the skeleton, you stop getting emotionally whipsawed by every talking head pivot. But that's not the part that matters most. The part that matters most is what this forces other participants to do. Because markets don't move on what you believe. They move on what other people are forced to buy or forced to sell. So let's talk about forced behavior, starting with silver, because silver is usually where the stress shows first. When silver moves from the 70s into the 90s in a couple of weeks, you're not looking at steady accumulation. You're looking at a market where liquidity thins, spreads widen, and participants who were short volatility suddenly discover they're short a very real object. Silver has industrial demand, it has investment demand, and it has a smaller, more skittish market structure. That combination makes it reflexive. When it rises, it attracts momentum. When it attracts momentum, dealers hedge. When dealers hedge, the hedging itself can become demand. And when demand hits a market with limited depth, you get air pockets and gaps. That's where the real pressure starts. Even if you've never touched an options chain in your life, you need to understand one clean mechanic: delta hedging. If a lot of call options are bought, the dealers who sold those calls often hedge by buying the underlying, especially as price rises and the option's delta increases. That can create a feedback loop where price rising causes more buying, which causes more rising. You don't need to claim gamma squeeze every time the chart goes vertical, but you do need to respect that options can turn a macro move into a mechanical move. And silver is the kind of asset where that can happen fast because the surface area of the market is smaller. Now layer in futures, structure and margin. Futures are leveraged. Leverage amplifies both upside and downside. Exchanges can raise margin requirements during volatile periods, which forces participants to post more collateral or reduce positions. That's not a moral judgment. That's risk management. But it has a market impact. Margin hikes from some can force selling into weakness and force covering into strength, depending on who's positioned where. If you've been around metals long enough, you've seen episodes where margin changes are a hidden accelerant. And that matters now because when silver is at 90 plus, daily swings are not cute. They are portfolio events. The next detail is what flips the whole setup. When volatility spikes, the system doesn't just price it, it uses it. Volatility becomes a tool to shake out weak holders, to trigger stops, to manufacture regret, and to bait you into buying tops and selling bottoms. That's why we're going to build you a psychology shield before the end. Because if you can't manage your own reactions, you don't get to keep the upside of being right. Now zoom back out to the macro spine. Real yields and break-evens aren't just numbers. They're an argument between three forces. Force 1 is central banks trying to control inflation without crashing growth. Force 2 is fiscal reality, debt servicing, auction schedules, refunding needs, the supply of bonds. Force 3 is politics, credibility, and institutional independence. And it is that third force that can suddenly make gold act wrong relative to textbook models. When markets perceive pressure on central bank independence, or even the risk of it, the currency risk premium can expand. And when the currency risk premium expands, gold is one of the first places it shows up because gold is globally priced and politically neutral. In early January headlines, there's been fresh tension around U.S. policy credibility and central bank independence, with news flow that has rattled the dollar and pushed safe haven demand. You don't have to overdramatize that. You just have to recognize the mechanism. If participants think policy could be influenced or destabilized, they demand a higher premium for holding nominal claims. Gold is the anti-nominal claim. And that's why gold can rise even when real yields are still positive, because the market is charging a trust premium. Everyone's watching the headline, but the signal is somewhere else. The signal is whether real yields can stay high without breaking something, and whether break-even stays sticky because inflation risk refuses to fade. And that brings us to the calendar, because the calendar is the catalyst. This isn't about guessing the next headline. It's about knowing when liquidity thins and when institutions are forced to rebalance. We're sitting right in January with a major Federal Reserve decision window coming up on January 27th at 28, 2026, and a critical Treasury funding window right after, with the next quarterly refunding documents scheduled for release on February 2nd, 2026. That's not trivia. That's a timeline. Those dates create a corridor where bond market positioning, inflation expectations, and real yield sensitivity can move quickly. Thin liquidity around holidays and month-end positioning can amplify it. And when bond market volatility rises, metals can react violently because they are the market's fastest credibility hedge. Because if this one level breaks, the math changes. Here's how you translate that into something actionable without turning into a fortune teller. First, stop treating gold as a single issue asset. It's a bundle. It's a dollar hedge, a real yield hedge, an uncertainty hedge, and in certain regimes, it's a policy credibility hedge. Different days, different components dominate. When you anchor to real yields and break-evens, you can tell which component is in control. If real yields are rising and break-evens are flat or falling, that's a headwind regime. If real yields are stable or falling and break-evens are rising, that's a tailwind regime. If both rise, gold can still rise if the trust premium is expanding and the marginal buyer doesn't care about carry. That's the hidden detail. And it asks why gold shouldn't be doing this is not a trade plan. It's a complaint. Now add the proof stack, because we are not doing vibes here. Proof point 1 is the raw price structure. Gold didn't just drift higher. It surged from the low $4,300 at the start of January into the mid $4,600s. That's a breakout. Breakouts matter because they change positioning. They force underweight funds to chase. They force shorts to manage risk. They attract trend-following flows. Proof point 2 is silver's behavior. Silver didn't lag. It exploded into the 90s. And when silver leads like that, it often signals that liquidity is thin and the market is punishing complacency. Proof point 3 is the inflation dashboard itself. Break-evens around the low 2% range remaining firm into mid-January tells you inflation expectations are not collapsing, even after a long period of "we won" narratives. Proof point 4 is the real yield level. Inflation-indexed yields around the high 1% range are still positive, which means gold's strength is not simply a rates down story. Something else is bidding it. Proof point 5 is the calendar of policy and funding. An FOMC meeting and a Treasury refunding release create a near-term catalyst window for bonds, and bonds are the transmission mechanism into metals through real yields and inflation expectations. Proof point 6 is the real-world symptom. In India, silver futures have been surging to record local currency levels, even crossing notable psychological thresholds, which is what global demand looks like when it hits local markets with their own liquidity constraints. Proof point 7 is behavioral. When metals go vertical, you see attempts to explain it away as irrational, which is exactly what happens when an asset is repricing something uncomfortable. The proof isn't one statistic, it's the stack. And the stack is screaming that the macro is not complicated here, it's concentrated. Now let's talk about why you should care about break-evens specifically, because a lot of people treat inflation expectations like a boring academic concept. Break-evens are not academic, they're a market price. They're what huge pools of money are willing to pay to transfer inflation risk. And when break-evens move, it tells you who is buying insurance and who is selling it. In a stable regime, break-evens grind. In a regime shift, break-evens jump. When they jump alongside noisy political or fiscal headlines, that's a sign that inflation risk is being repriced as a structural feature, not a one-month data point. And here, like the trap that chews up retail investors, they wait for CPI or a jobs report to confirm what the market already priced. The market moves first. Then the narrative shows up later wearing a suit. If you want to stop being late, you watch the dashboard. Real yields and break-evens move every day. CPI prints once a month. Which one do you think leads? But that's not the whole setup, because even if you nail the macro read, the next hurdle is execution psychology. Metals are not polite, they don't trend in a straight line. They knife down, they rip up, they gap on weekends, and they punish leverage. You can be right on the thesis and still get wrecked by volatility if you're done to separate trend signal from noise. So here's the psychology shield, and it's simple. Expect violence, pre-commit to what matters, treat drawdowns as a feature, not a surprise. The market will try to make you feel stupid for holding through a pullback. It will try to make you feel like a genius at the top. Both feelings are traps. If you're trading, define your invalidation. If you're investing, define your time horizon and your maximum pain you're willing to tolerate without changing the thesis. And never confuse a fast red candle with the story changed. Usually it means liquidity changed. Usually it means someone got forced. Usually it means stops got harvested. And when the story actually changes, you'll see it first in the dashboard. Real yields ripping higher while break-evens roll over, the dollar catching a persistent bid, credit spreads widening for real, not just for a day. That's what a real regime change looks like. Now let's put some structure around what comes next, because this is where most videos either become pure hype or pure caution tape. We're not doing either. We're doing a two-scenario lens. Scenario 1 is the controlled pullback and retest. In this scenario, gold pulls back from the mid-4,600s, maybe retests the low 4,600s, or even the high 4,500s, and buyers show up without the dashboard deteriorating. Real yields stay stable or drift lower, break-evens remain firm, and the pullback is a reset of positioning, not a collapse of the macro thesis. That scenario is healthy. It shakes out late longs, refills liquidity, and sets up a more sustainable leg. Scenario 2 is the continuation squeeze. In this scenario, gold holds above key psychological zones and pushes higher quickly, especially if real yields drop rapidly or if break-evens pop while nominal yields wobble. Silver, in that scenario, becomes the accelerator. Because if silver holds the $90 area and starts reclaiming recent highs, the reflexivity can intensify. That's where gap risk lives. That's where weekend headlines matter. That's where you can wake up to a different price. Neither scenario is guaranteed. Both are plausible. Your job is not to predict with certainty. Your job is to recognize which one is unfolding and not get emotionally bullied into the wrong decision at the wrong time. So what are the levels that matter in plain English? For gold, the mid-4600s has been the battleground. Think of roughly $4,600 as a psychological and recent action zone. Above it, the market is telling you bids are still willing to pay up, even with real yields not collapsing. Below it, the question is whether it's a shallow dip that holds and reclaims quickly, or whether it turns into a deeper retest into the high 4500s where momentum players start to second guess. A clean breakdown through the mid 4500s with real yields surging and break-evens fading would be your first real warning that the macro tailwind is stalling. For silver, $90 is the emotional line. Above $90, the tape stays hot and reflexive. Lose $90 and you start watching the mid to high 80s zone where recent momentum built and where a retest could either reload the move or crack confidence. And here's the key. Levels alone are not enough. Levels plus the dashboard is the edge. If price breaks a level but the dashboard supports the thesis, that move can be a stop run. If price breaks a level and the dashboard flips against you, that's when the math changes. Because if this one level breaks, the math changes. Now let's talk about what to watch next. The way a professional would, not the way a gambler would. First, watch the 10-year real yield. You don't need to stare at every tick, but you do need to know direction and momentum. If real yields start rising hard, especially if they push up and stay up, that's gravity returning. Second, watch the 10-year break-even. If break-evens stay firm or rise while real yields soften, that's fuel. If break-evens roll over hard, that's inflation risk getting repriced down, which can take air out of metals even if the long-term story is intact. Third, watch how metals respond to bond volatility around the January 27-28 Fed meeting. The decision itself matters less than the reaction function. Do real yields fall because the market believes policy will ease, or do they rise because the market believes inflation will be fought harder? Does the dollar strengthen or weaken after the message? Gold is not allergic to tight policy if the trust premium is expanding, but it does react to sharp, sustained shifts in real yields. Fourth, watch the Treasury funding narrative into early February, especially around the February 2 refunding documents. Big funding needs, auction digestion, and term premium dynamics can move the entire yield complex. That feeds directly into real yields and break-evens. Fifth, watch silver's behavior as a stress indicator. If silver's volatility gets crushed while gold holds up, that can signal de-risking. If silver stays bid and refuses to give back gains even on down days, that tells you demand is deeper than speculative froth. Sixth, watch for mechanical stress. Sudden margin changes, sharp intraday reversals with no news, widening spreads. Those are signals of positioning and liquidity, not the story. And that's where the real pressure starts. Now, let's address the skeptics directly, because skepticism is healthy here. The skeptical case says this is overextended, this is crowded, this is a blow-off, and real yields being positive means the opportunity cost will eventually bite. Fair. The rebuttal is not you're wrong. The rebuttal is conditional and mechanical. If the next 2 weeks deliver softer real yields, sticky break-evens, and continued credibility stress around policy and funding, then the market can keep paying the trust premium, and that premium can overwhelm carry. But if real yields jump and stay high while break-evens sag, the trust premium can compress and metals can correct hard. That's the game. And it's why you never marry a price, you marry a process. This is also where people get emotionally manipulated. On the way up, they'll show you a chart and call you stupid for not buying earlier. On the way down, they'll show you the same chart and call you stupid for ever believing. Both are designed to trigger shame and impulsive action. Your shield is simple. You're not trying to be early, you're trying to be right with risk controlled. You're not trying to catch every dollar, you're trying to catch the regime. Metals can whip around violently even if the thesis is correct. Let me say it again because this is where accounts die. Metals can whip around violently even if the thesis is correct. That's why your plan needs room for noise and why your invalidation needs to be tied to the dashboard, not just a candle. Now, one more piece of the hidden detail, because it's the part that keeps people stuck in old models. In a world where reserve diversification is happening and geopolitical risk is real, gold can attract institutional flows that are not price sensitive the way traders are. Those flows care about allocation, not entry. They care about reducing single currency exposure, not squeezing an extra 1%. When that kind of demand is present, gold behaves less like a trade and more like a balance sheet decision. You can't always see that day to day, but you can infer it when gold holds up through conditions that would normally crush it. That is what makes this setup so important. It is not just about today as candle. It's about whether we are in a regime where purchasing power insurance is being repriced structurally. Silver is trickier because it's more sensitive to industrial cycles and liquidity, but silver also benefits when gold legitimizes the precious complex and when inflation expectations stay alive. So here's the near-term roadmap in one flowing sequence. If over the next week you see real yields drifting down from the high 1% area, while break-evens remain firm around the low 2% area, and gold holds above the key psychological zone around $4, $600, with silver not collapsing under $90. That's the controlled retest to continue regime. You expect pullbacks, you respect volatility, but you don't panic sell the first red day. If instead you see real yields popping higher and staying there while break-evens fade and metals lose key levels and fail to reclaim them, that's the regime where the market is telling you the trust premium is compressing and you get more defensive. And if you get the squeeze scenario, real yields drop fast, break-evens rise, and metals rip, then the danger isn't missing it. The danger is chasing it with no plan, getting wrecked by the inevitable snapback. In squeeze regimes, your enemy is not the market. Your enemy is your own urgency. Because if this one level breaks, the math changes. Last thing, and it's a quiet CTA, not a beg. If you're still here, you're already in the small minority that wants mechanisms, not bedtime stories. Stay in that lane. Build the habit of checking the dashboard first, real yields, break-evens, then price. Talk with people who can handle uncertainty without turning it into a religion. And when the next wave of volatility shows up to emotionally manipulate you, remember, the goal is not to feel calm. The goal is to behave rationally while everyone else is being pushed around. Watch the calendar into the Fed window on January 27, 28. Watch the Treasury funding narrative into early February, and let the bond market tell you whether purchasing power is getting cheaper or more expensive. Because when real yields and break-evens move together, the macro really is simple, and the tape is just the messenger.